Hello, and welcome back to Fininsergy. If you've been struggling with understanding how to truly make your money grow, today's video is for you. We're going to talk about one of the most powerful concepts in personal finance that has the potential to change your financial future forever: compound interest. Compound interest is often referred to as the eighth wonder of the world, and for good reason. The ability of your money to grow exponentially over time is not something that happens overnight. But with patience and smart investing, you can harness the power of compound interest to create wealth. In this video, we're going to break down how compound interest works, how you can use it to grow your wealth, and the best strategies for investing wisely. Whether you're new to investing or already have some experience, understanding compound interest will be a game changer for you. Before we jump into the details, make sure to subscribe to Fininsergy and hit the notification bell so you don't miss out on our future videos that will help you take control of your financial future. Ready to unlock the power of compound interest? Let's dive in. 1. What is compound interest? First things first, let's talk about what compound interest is. At its core, compound interest is the interest on a loan or investment that is calculated based on both the initial principal and the accumulated interest from previous periods. In simpler terms, compound interest allows you to earn interest on the money you've already earned. This creates a snowball effect, where your interest keeps generating more interest, and your wealth grows exponentially over time. Let's take a quick example to illustrate how it works. Imagine you invest $1,000 in an account that earns 5% interest per year. After the first year, you would earn $50 in interest, $1,000 x 0.05. But here's where the magic of compound interest happens. In the second year, instead of earning interest on your original $1,000, you now earn interest on the total amount in your account, which is $1,050. So, in the second year, you earn $52.50 in interest, $1,050 x 0.05. As time goes on, the interest earned each year increases because you're earning interest on your interest. This compounding effect is what allows your money to grow faster as time passes. 2. Why compound interest is so powerful. Now that you understand the basics of compound interest, let's dive into why it's such a powerful tool for building wealth. The key lies in time and compounding frequency. Time is your best friend. The longer you invest, the more your money will compound. Even small contributions can turn into significant wealth over time. The earlier you start, the more time your money has to grow. Let's look at an example to highlight the importance of time. If you invest $5,000 today at a 6% annual return, it will grow to $18,000 in 30 years. But if you wait 10 years to start, you'll only have $10,000 after 30 years at the same 6% return. This illustrates why starting early is crucial. Your money has more time to grow and compound. Compounding frequency matters. The more frequently your interest compounds, the faster your wealth grows. In some cases, interest compounds annually, while in others, it may compound monthly, daily, or continuously. For example, let's say you invest $1,000 at 5% interest. If interest compounds annually, you'll earn $50 in interest each year. But if it compounds monthly, you'll earn more than $50 in interest because your interest is being calculated and added to your balance more frequently. By understanding how different compounding frequencies work, you can choose investments that maximize the power of compound interest. 3. The best investment vehicles for compound interest. Now that you understand how compound interest works and why it's so powerful, the next step is to know where to invest to take full advantage of this financial concept. There are several investment vehicles that can help you harness compound interest effectively. High-yield savings accounts. While they don't offer huge returns, high-yield savings accounts are a safe way to earn interest on your money. The interest compounds regularly, making this a good option for short-term savings. Stocks and index funds. One of the most popular ways to build wealth through compound interest is by investing in stocks or index funds. Historically, the stock market has provided an average annual return of 7 to 10%, and when you reinvest the dividends and capital gains, you're compounding your returns. Bonds and CDs. Bonds and certificates of deposit CDs are low-risk options that offer fixed interest rates. While they typically offer lower returns than stocks, they can still provide consistent interest over time. Many bonds and CDs allow your interest to compound, which can help grow your investment over the years. Retirement accounts, 401k and IRA. Retirement accounts like 401k, and IRAs are excellent tools for compounding your wealth over time, especially because they offer tax advantages. By contributing regularly and allowing your investments to grow tax-deferred or tax-free, you can see significant growth in the long run. 4. The Rule of 72. A quick way to estimate how long it takes for your money to double approximates 600 words. One of the most helpful tools in understanding compound interest is the Rule of 72. This simple formula allows you to estimate how long it will take for your money to double at a given interest rate. The Rule of 72 works like this. Divide 72 by the interest rate to estimate how many years it will take for your investment to double. For example, at an interest rate of 6%, it will take 12 years. 72 divided by 6 is equal to 12 years. At an interest rate of 8%, it will take 9 years. 72 divided by 8 is equal to 9 years. The Rule of 72 is a quick and easy way to visualize the power of compound interest and understand how small changes in your interest rate can significantly impact your wealth-building journey. 5. The power of reinvestment. Maximizing your returns. One of the most important things to remember when using compound interest is the importance of reinvesting your returns. This means that instead of cashing out your dividends, interest, or capital gains, you reinvest them back into your investments, allowing them to compound even more. Let's say you invest $1,000 in a stock that provides a 5% annual return. After 1 year, you'll have earned $50 in interest. If you reinvest that $50, you will now earn 5% on $1,050 instead of just $1,000. Over time, this strategy leads to exponential growth. The more you reinvest your earnings, the faster your money will grow. Reinvesting allows you to take full advantage of compound interest, creating a snowball effect that builds wealth over time. Now that you understand the power of compound interest and how to use it to grow your wealth, it's time to take action. Remember, the key to building long-term wealth is starting early, staying consistent, and reinvesting your earnings. Whether you're investing in stocks, bonds, retirement accounts, or any other vehicle, the magic of compound interest will work in your favor. If you found this video helpful, make sure to like, subscribe, and share it with others who could benefit from learning about the power of compound interest. Have questions or want to share your experiences with investing? Drop a comment below. I'd love to hear from you. Thank you for watching, and remember, building wealth takes time and patience. Keep investing, stay disciplined, and watch your money grow.